Click the bell icon to get latest videos from Ekeeda.
Friends, when a new partner is admitted into partnership firm, partners may decide to change their capitals based on their revised profit sharing ratio. When new partner is admitted, firm's profit sharing ratio changes. Based on this new profit sharing ratio, particularly based on capital brought by new partner, all partners' capitals are adjusted so that capital of new firm will be shared in new profit sharing ratio by all partners including new partner. How accounting effects are to be given, that we'll understand in this question. Let us read question. Manoj and Rahul are equal partners. So profit sharing ratio is 1:1. Their balance sheet as on 31st March 2013 stood as under. Balance sheet. Assets we have cash at bank 1,20,000. Debtors 62,000 less RDD. Net debtors 60,000. Bills receivable, building, machinery. Liabilities, sundry creditors, general reserve. This will be split between old partners. Manoj 18,000, Rahul 18,000. Capital of Manoj Rahul. Capital account, credit. They decided to admit Amit on 1st April 2013 on following terms. The machinery and building to be depreciated by 10%. Machinery, here we have 48,000. It will be reduced by 4,800. Building 1,14,000. It will be reduced by 11,400. Second effect, in case of both the assets, profit and loss adjustment account debit. Reserve for doubtful debts to be increased up to 5,000. Already it is given 2,000 here, so we are required to add 3,000 to RDD. And second effect, profit and loss adjustment account debit. Bill receivable are taken over by Manoj at a discount of 5%. Bill receivable are 24,000. It is taken over by Manoj. So in new balance sheet, you will not have bills receivable. Whole amount we are required to deduct. It is taken over by Manoj at 5% discount. 5% of 24,000. It comes 1,200. This 1,200 will have to debit to profit and loss adjustment account. 24,000 minus 1,200. 22,800, for which Manoj account will be debited. Whole 24,000 will be deducted from asset. The amount of creditors paid at discount of 10%. Creditors, here we have 1,80,000. Whole of creditors are paid. So on liability side, we are required to reduce 1,80,000. Whole creditors will go. In new balance sheet, there will not be any creditors. Profit and loss account credit side will be crediting discount received, that is 18,000. Bank account credit side 1,80,000 minus 18,000. So it will be 1 lakh. $1,62,000 will be credited to bank account because payment is made. the capital account of all the partners be adjusted in current account of partners. We are required to calculate your new profit sharing ratio, and then we are required to adjust all partners' capital accounts. Any difference comes in all partners' capital account will be transferred to their current account. Amit should bring 80,000 as capital. Amount is received, so bank account will be debit and Amit's capital account will be credit for 1/4 share in future profits. Goodwill account be open in the books of the firm for 40,000. So this is goodwill raised. Goodwill account will be debited for 40,000 and old partners capital account will be credited. Old partners capital will be credited 20,000 each. Prepare profit and loss adjustment account, partners capital account and balance sheet of new firm. New profit sharing ratio we are required to calculate. Step 1, find balance of 1. That is, if we assume profit of new firm ₹1, we have to deduct new partner share. So 1 minus new partner share 1/4. It comes to 3/4. Step 2, new ratio of old partners. Formula is balance of 1 multiplied by old share of old partner. Here balance of 1 is 3/4. So in case of Manoj, 3/4 multiplied by half, it comes to 3/8. In case of Rahul, 3/4 multiplied by half, it comes to 3/8. So new profit sharing ratio is Manoj 3/8, Rahul 3/8 and Amit, out of total 8 shares, 3 are given to Manoj, 3 are given to Rahul. So Amit's share will be 2/8. 2/8 is nothing but 1/4. So we got new profit sharing ratio 3:3:2. In this ratio now we are required to decide capitals of old partners. Total capital of new firm, capital of new partner 80,000 multiplied by reciprocal of new partner share. New partner share is 1/4, reciprocal will be 4/1. It comes to 3,20,000. This is the total capital of new firm. Total capital of new firm we can calculate as 3,20,000. Now Manoj's new capital, total capital multiplied by his share. So total capital 3,20,000. Manoj share 3/8, so it will be 1,20,000. Total capital 3,20,000. Manoj share 3/8. Rahul's share is also 3/8. It is 1,20,000. So finally Manoj's new capital 1,20,000. Rahul 1,20,000 and Amit 80,000. Let us continue with postings. On liability side we have partners capital Manoj 90,000, Rahul 60,000. This will be credited to their capital accounts. Partners capital account credit Manoj 90,000, Rahul 60,000. Liability side we have general reserve 36,000. This will be divided in ratio of 1:1. Partners capital account credit by general reserve Manoj 18,000, Rahul 18,000. Relating to partners capital we have general reserve 36,000, that is divided among the partners equally. Sundry creditors 1,80,000. This will be recorded on liability side. Liabilities sundry creditors 1,80,000. Asset side we have cash at bank 1,20,000. Bank account debit side. To balance brought down, amount is 1,20,000. Debtors, there is adjustment. Debtors 62,000. There is adjustment of RDD. Bills receivable 24,000. Asset side, bills receivable 24,000. Building 1,14,000. Machinery 48,000. They decided to admit Amit on 1st April 2013 on following terms. Machinery and building to be depreciated by 10%. Machinery, here we have 48,000. From machinery we are required to reduce 10%. It's 4,800. Balance of machinery 43,200. Profit and loss adjustment account debit to machinery 4,800. Building 1,14,000. Depreciated by 10%. It is 11,400 will be deducted 1,02,600. Second effect of this, profit and loss adjustment account debit. Profit and loss adjustment account debit to building 11,400. Reserve for doubtful debt to be increased to 5,000. Debtors 62,000 less RDD 5,000. Net debtors 57,000. Existing RDD is 2,000. We are required to increase it by 3,000. Second effect of this 3,000, profit and loss adjustment account debit to RDD 3,000. Bills receivable are taken over by Manoj at a discount of 5%. Bills receivable are given here 24,000. Bill receivable 24,000. Taken by Manoj. So now in new balance sheet, there will not be item bills receivable. Manoj capital account debit to bills receivable 22,800. Profit and loss adjustment account debit to bills receivable 1,200. That is discount given to Manoj while giving bills receivables. Amount of creditors paid at a discount of 10%. Creditors are 1,80,000. They are paid and settled. So in new balance sheet will not have creditors. Profit and loss adjustment account credit by creditors 18,000. This is discount received on payment of creditors. Creditors paid 1,62,000 after adjusting discount of 18,000. Capital account of all partners to be adjusted in current account of partners. Amit should bring 80,000 as capital. Bank account debit to Amit's capital 80,000. Partners capital account credit by Amit's capital 80,000. Goodwill account be open in the books of the firm at 40,000. Goodwill account debit to Manoj's capital account to Rahul's capital account 20,000 each. Total goodwill raised rupees 40,000. Goodwill account is closed. Balance is 40,000. This 40,000 will be recorded on asset side. Goodwill account is not closed. Therefore, goodwill appears in new balance sheet. By balance carried down 38,000. Bank account is closed. We are getting balance 38,000. Balance sheet asset side. Bank balance is 38,000. We can close now profit and loss adjustment account. Profit and loss adjustment account credit, we are getting balancing figure 2,400. This is a loss on revaluation. This will be distributed equally in old ratio among Manoj and Rahul. So 1,200, 1,200. Partners capital account debit, Manoj 1200, Rahul 1200. Now we can close partners capital accounts. As per our working note, revised capital of partners, Manoj 1,20,000, Rahul 1,20,000, Amit 80,000. Partners revised capital are recorded over here to balance carried down, Manoj 1,20,000, Rahul 1,20,000. Capital account of Manoj 1,20,000, Rahul 1,20,000, Amit 80,000. Now we can close partners capital accounts. Partners capital accounts are closed. We are getting balance Manoj 16,000, Rahul 23,200. It is transferred to their current accounts. Balance of current account is transferred on asset side. Manoj 16,000, Rahul 23,200. Balance sheet asset side total is 3,20,000. Liability side total is also 3,20,000. That means balance sheet is tally. In this question we learn how to adjust capitals of old partners in new profit sharing ratio, taking base of new partners capital. Thanks for watching this video. Stay tuned with Ekeeda. Subscribe to our channel Ekeeda. Thank you.